The best time to invest is when everything is on fire. And I don't mean fire in a good way. So the market is in a recline. The market is going down. And with every time the market goes down, whether it goes up, it's a crash, it's just a recline, it's a correction, it doesn't matter. When the market changes, so does our emotions. And with the market going down, it's a lot of negative emotions. So I've been seeing a lot of posts on Reddit lately of people that are sharing their emotions. Now, it's natural for us to have emotions when it comes to investing. I do have them too. But it's important to make sure that you do not let your emotions guide your decisions. Always think about it logically. So if you're one of these people and you're letting your emotions decide for you, you might end up losing. So I'm going to explain in this video why you should think logically, and I'm going to show you the numbers to back it up. Okay, so what does historically the data show? Well, I'm going to show you a picture which shows the S&P 500, for example, in its lifetime. And as you can see, the people that stayed invested always made money. I'm going to show you some different examples, and you will see that even though there were crashes, there were downs, there were reclines, the market always went back up again, which is important because history repeats itself. Now, don't take this as any advice or whatever, because I'm not a financial advisor, but this is just what the history shows. The market will always go back up again. So why do people panic sell? Like I said, it's emotions. People see it go down and they want to sell off before it crashes even further. Now, for people like me, the dividend investors, we like to stay put. And to be honest, again, this is not advice, but seeing the market go down, it's a sale, it's a discount, and I'm happy to buy even more the lower it goes. But that's just my opinion, but look at the graphs, they go back up, and that's important to know. So if you stay put, there is a better chance that you will earn money instead of panic selling, trying to get rid of those stocks. Okay, so here's a simple chart that shows exactly how it works if you keep investing, if you sell and try reinvesting after 6 months and after 12 months. Maybe depending on how long the crash or recline is. This might even be worse if you're waiting longer. So why does keeping investing when the market declines actually work? Well, as I previously stated, that the market will always go back up again. So if you keep investing, the lower prices of the stocks at that moment due to the recline or crash or whatever, they will eventually go back up, adding to your portfolio wealth. Now, so not only are you buying cheaper stocks, they will also generate more value to your portfolio because they will regain their lost value over time. So you keep investing and it just goes back up, meaning you add so much more value to your portfolio. Now, if you sell it off, most likely, if you're in a bad luck, you will actually lose money on selling those stocks. Maybe you just bought fresh new stocks and now you're going to sell it for a lower price, meaning you already lost money. But even if you don't lose money on selling out, you still lose out on buying more stocks at a lower price, which can increase in price once the market goes back up. So you lose out on so much easy stocks and so much compound interest. And compound interest, that's the magic. That's the real magic that we all aim for, that we all want. So dipping out just really hurts your portfolio. Okay, quick pause. If this European style investing tips is useful to you and you like them, please subscribe, because I'm building a library with a lot of videos in it for European specific fire. Okay, so now we've talked about the general things that happen, such as the market always going back up again, and showing you the difference between selling and just staying invested. But what about European specific things? Well, if you're Dutch and you're using box 3 for your taxes, it actually assumes fictional gains over your assets. Meaning it doesn't matter if your portfolio lost 20%, you still pay taxes on fictional gains. So for us, the Dutchies, it's even more important to stay invested so you can capitalize on those numbers going back up after the crash is done and the market goes back up again. So next up is, us Europeans, we don't have the same ETFs like the S&P 500, we have UCITS. I've talked about on the other video. If you want to watch that, I'll link it above. What about those? You might think that they are different than the real ETFs that most people know, that they might behave differently. But that's not the case. They're just index funds and they will go back up as soon as the market will go up as well. So don't let that scare you off. Just stay invested, keep putting money in, and if the market goes up, so will your stocks and so will your UCITS. And then one last thing for us Europeans, since we don't have a 401k, Roth IRA, etc., we actually only can get out 3.5% instead of the 4% safe withdrawal that the Americans have. Meaning we have to invest just a little bit more than the Americans. Meaning we need that compound window to be a little bit longer. So needing a longer window for compound to take place, that means we need to stay invested for longer. So selling your stocks and not investing for several months can really hurt your portfolio. So again, take this with a grain of salt. I'm not a financial advisor, but if I were you, I would just stay invested, just keep through to your roots, stick with the plan and just wait it out. So with that in mind, and the market that will eventually recover, remember this: your portfolio, your FIRE number is not your current number, and the prices will go back up again and you will reach your FIRE goal if you are consistent. Now if you have any questions, please let me know in the comments. I read all of them and I can reply to them, and see you in the next one.